This is Blue Nile here. We'll break down the fundamentals of auditing step by step, starting with an introduction to non-current assets. Non-current assets, also known as fixed assets, are resources a company owns that are expected to provide economic benefits over a long period, usually more than 1 year. Key types of non-current assets include property, plant and equipment (PPE), tangible assets like buildings, machinery and vehicles, intangible assets, non-physical assets such as patents, trademarks, and goodwill, long-term investments, investments held for more than a year, such as bonds or shares in other companies. Auditors focus on assertions like existence, valuation, and ownership when testing non-current assets to ensure they are properly recorded and accurately reflect the company's financial position. Let's get started with our tutorials. Verifying existence through physical inspection. This video is the first of a series that will take you through some practical examples of substantive audit procedures you can carry out on specific balances in the financial statements. We will cover the general principles in designing and performing audit procedures, some general procedures you can perform on any balance, and then substantive audit procedures for non-current assets, bank receivables, inventory estimates, trade payables, the statement of profit and loss, and share capital, reserves, and directors' emoluments. This video will cover the general principles, general procedures, and non-current assets. We have covered the topic of gathering evidence in another video. Many of the principles discussed relate to substantive audit procedures. It is recommended that you review the gathering evidence and financial statement assertion videos before you watch this one. It will give you a better understanding of what we are covering here. Remember, substantive audit procedures are procedures that identify if material misstatements are present within the financial statements. They are testing the transactions, balances, and disclosures for these misstatements. The steps to performing a substantive test are: identify the item to test and set the objectives of the test. Consider the quality of evidence required. It must be sufficient and appropriate. Design the test and ensure it meets the objective. Select the sample of transactions to perform the test on. Record the test, method, results, and other evidence as working papers in the audit file. Consider the conclusion of the test. Is further work required? Are there material misstatements to be amended in the financial statements? The objective of a substantive test must be at least one of the financial statement assertions, again covered in the gathering evidence and financial statement assertions videos. As a recap, here are the financial statement assertions: completeness, rights and obligations, allocation and valuation, existence, cutoff, occurrence, classification, and accuracy. There are many examples of practical substantive tests. We are going to discuss a few for each area of the financial statements you would typically see in the exam. This will give you some specific practical ideas you can use. Before we do this, there are some things you could do for any balance. Some ideas can be remembered using TOAD. T is trial balance. Auditors will want to ensure that the financial reporting system agrees with what has been presented in the financial statements. An audit procedure would therefore be to agree the balance in the financial statements to the trial balance. Any balances not included in the financial statements would then be investigated with the client. O is opening balance. Every balance in the statement of financial position will have an opening balance carried forward from the previous year. For the closing balance to be correct, the opening balance must also be correct. An audit procedure would therefore be to agree the opening balance to last year's closing balance and investigate any differences with the client. A is add up and recalculate. There is always something the auditor can add up. All balances need to be checked for accuracy. Examples could be to add up the receivables list to agree the balance, recalculate a sample of employees' net pay, or add up the bank reconciliation. Each of these and many more will ensure the assertion accuracy is achieved. D is disclosure check. The auditor needs to ensure that any specific guidance on how the balance or disclosure is formed and presented has been followed. They therefore need to review any specific accounting standards relating to the areas of the financial statements and ensure they have been followed when preparing the financial statements. With a few general procedures out of the way, we can now look at some specific balances you might see in an exam. We will start with non-current assets. In order to ensure non-current assets are audited effectively, the auditor will need to review the financial statements, including the statement of financial position and the non-current asset note, the asset register, which includes all details relating to the assets held by the company, and the trial balance and ledger accounts, forming the non-current asset balance. Each of these sources should tie in with one another, and it is the auditor's job to test whether that is the case. Non-current assets' key assertions to be verified are completeness, rights and obligations, valuation, and existence. If we visualize the non-current asset note, the auditor needs to ensure each balance has been audited, therefore auditing opening and closing balances, new assets purchased or additions, disposals of assets in the year, depreciation, and revaluations. Audit procedures for opening and closing balances include agreeing the opening balance to last year's financial statements, adding up the non-current asset note to ensure the auditor agrees with the closing balance shown, and agree the closing balance for non-current assets in the note to the balance shown on the statement of financial position. For new assets purchased, audit procedures include agreeing the additions balance in the financial statements to the asset register. This will verify completeness. Adding up the additions in the asset register to ensure they agree with the total in the financial statements. This also verifies completeness. And for additions in the year, trace to the invoice to agree the amounts recorded and whether the invoice is in the company name. This verifies rights and obligations. For disposals in the year, the auditor should obtain a list of all disposals of assets made in the year and agree to the asset register to ensure that they have now been removed. They can agree disposals to documentation, for example sales receipts and bank statements, to prove that they were disposed of, and review the profit or loss on disposal, and agree with what has been recorded in the statement of profit and loss. These verify existence and accuracy. Depreciation must be audited by recalculating the depreciation charge for a sample of assets, reviewing the accounting policies to see if the treatment being used is consistent with prior years, and inspecting the budgets for capital expenditure to see if plans for disposals and new assets mean the depreciation methods are appropriate. These will help you verify valuation and accuracy. The revaluation of assets must be carefully reviewed. Some ideas for procedures would be to inspect the valuer's report and agree the amount concluded by them with what has been recorded in the financial statements. Review the methods used by the valuer, described in their report, and ensure they agree with what is required by the accounting standards for revaluations. The key for an auditor is to gather as much sufficient appropriate evidence when performing these types of audit procedures. Remember that the more written, detailed, independent evidence they can collect, the better. Each audit procedure must verify at least one of the financial statement assertions. It is key to the balance being audited. I hope you found this video useful. When ready, move on to the next video, which covers the audit of current assets.